Hello, dear friends. This is Dr. Naresh Pinamkar again from Maharashtra Mahavidyalaya Nilanga. Today we are going to discuss about the paper Fundamentals of Income Tax, and we are going to discuss the basic concepts in income tax. As you all know, to collect the income tax from different types of assessees, the central government of India has passed Income Tax Act 1961, and under this act, the assessees are determined and they are charged for tax upon their income. So, to understand the procedure of charging the income tax, we need to understand what are the basic concepts in Income Tax Act 1961. So, today we are going to discuss about the three basic concepts. The first one is assessment year, the second one is previous year, and the third one is assessee. So let's see what these basic concepts are. Now, what do you understand by assessment year? The Section 2, subsection 9 of the Income Tax Act 1961 provides the definition of assessment year. It says the assessment year means the period of 12 months commencing on the first day of April every year and to be ended by 31st March of the immediate following year. The financial year of the government is the assessment year for all categories of assessees. It means whatever the financial year the government has uh, described, that is from commencing from 1st April to ending to the 31st March of the next year, is the assessment year for every assessee. Now, important points of assessment year. It is the period of 12 months, full 12 months are there. It starts on 1st April of every financial year and ends on 31st March of immediately following year. It is also called as income tax year. The current financial year is, for that matter, 2020-21. Now, the second concept, what is the previous year? Previous year, according to the section 3 of Income Tax Act 1961, previous year means the financial year of the assessee immediately preceding the assessment year in which the income is earned. Previous year is also known as accounting year or income year. Now, important points regarding previous year. Previous year is a period of 12 months or less, but ending on the 31st day of March every year. It is not essential that the previous year should be of 12 months all the time. It can be less than 12 months, but it cannot be more than 12 months. Financial year ending on 31st March will be the uniform previous year for all taxpayers. If a business starts on any day in a financial year, it should close its books of accounts on 31st March of immediately following or the same year. It means any business can start on any date in a financial year or in a financial calendar, but its accounts or its books of accounts must close on 31st March of the immediately following or the same year. Now, from this table, we can have an elaboration what is the difference between assessment year and the previous year. Previous year, in case of newly started business, if a business is started on a newly basis, what should be its previous year? Date of commencement of business is shown in one column, whereas the date of ending the previous year is shown on the other column. Suppose a business is started on 2nd April 2019, the date of ending the previous year will be 31st March 2020. Again, suppose the business starts on 15th June 2019, it will end on 31st March 2020. If a business starts on 1st January 2020, 2020, the previous year for that business will end on 31st March 2020. Suppose a business starts on 30th March 2020, it will be closed on 31st March 2020, means for only 2 days that previous year will be there. Now, exceptions for previous year. There are some exceptions under this act. In general, the income earned during the previous year is taxed in its relevant assessment year, but there are certain exceptions to it. In the following cases, the income is being taxed in the same year in which it is earned. Number one, shipping business income of non-resident ship owners under section 172 of the Income Tax Act 1961. In case of persons leaving India under section 174, under section 175, persons likely to transfer their assets to avoid paying tax, and under section 176 in case of discontinued business. So these are the four exceptions for which the previous year is the same year in which the income is earned. It means the accounting year itself is the previous year for these four cases. Now, let's understand how we should find out what is assessment year and what is the previous year. In the first column, you are seeing assessment year, and the other column is for previous year. Suppose if assessment year is 2001-2, the previous year shall be 2000-2001. If the assessment year is 2015-16, the previous year shall be 2014-15. If the assessment year is 2020-21, the previous year shall be 2019-20. Now, the third important concept, that is assessee. Assessee in simple words means taxpayer, the person who needs to pay tax. The section 2 subsection 7 of the Income Tax Act 1961 defines the concept of assessee. Assessee means a person by whom any tax or any other sum of money is payable under this act, and includes certain things. Number one, every person in respect of whom any proceedings under this act have been taken for the assessment of his income or of the income of any other person in respect of which he is assessable, or the loss sustained by him or by such other person, or of the amount of refund due to him or to such other person. Number two, every person who is deemed to be an assessee under any provision of the Act. There are some provisions in the Act under which a person can be deemed to be an assessee. Every person who is deemed to be an assessee in default under any provision of this Act. So, these are the types of assessees. Now, we are moving further. Section 2, subsection 24 is about the concept of income. Income means money or money's worth received from any definite source with certain amount of regularity. It is a periodical receipt from one's business, land, work, investment, etc. The Act does not define income, it simply lists some of the items that can be included in the income. They are profit or gain, dividend, interest, voluntary contribution received by a charitable institution, value of perquisites or profit in lieu of salary, interest, salary, bonus, commission, or remuneration earned by a partner of a firm from such firm. Capital gains, profit and gains from the business of banking carried on by a cooperative society with its members, winnings from lotteries, crossword puzzles, races including horse races and card games, gambling or betting, deemed income, any sum contribution to PF or superannuation fund by the employers. PF means here Provident Fund. Any sum received from under Keyman insurance policy taken by a person on the life of another person, the profit and gains of business of banking, any consideration received excess for issuing shares exceeds the fair market value of the shares, any advance received for negotiation for capital assets and fails negotiation. Again, subsidy received from reimbursement, LPG and other subsidy not included. Any sum received or value of property received without consideration or inadequate consideration on or after 1st April 2017. Compensation due or received in termination of employment. Fair market value inventory converted into or treated as capital asset with effect from assessment year 2019-20. Gift exceeds rupees 50,000 received by an individual of or HUF from any person during the previous year without consideration. Now, another concept, that is gross total income. Section 80B, subsection 5 of the Income Tax Act 1961 defines gross total income. Gross total income means the total income computed in accordance with the provisions of this Act before making any deductions under Section 80C to 80U. It is the aggregate of taxable income under the different heads of income, such as income from salary, house property, income from profits or gains of business, capital gains, or other sources. Total income. Total income means the amount left after making the deductions under Section 80C to 80U from the gross total income. Income tax will be calculated on this total income. So, this income is also called taxable income. Now, to recognize the income from various sources, the Income Tax Act 1961 has divided the term income into five groups or five heads. The Income Tax Act 1961 has recognized following five heads of income: income from salary, income from house property, profits and gains from business or profession, income from capital gain, and income from other sources. So, friends, today we are going to stop here. If you like the video, please like it, share it, and subscribe it. Thank you. We will meet soon.